Oil stocks in the energy sector have crashed this year, with the group plunging almost 34% so far in the year, underperforming the market by 48%, and the hot tech sector by nearly 72%. In this video, I'll show you why energy could be the breakaway sector of 2021. I'll share the research why energy stocks could bounce fast, why electric vehicles will not be the death in oil demand, and then reveal 5 stocks I'm watching for 2021. We're talking top oil stocks to buy today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I know a lot of you out there are hesitant to invest in oil stocks, but you cannot ignore this sector for 2021. We're 2 months into our portfolio on StockCard, and the 2 energy stocks are the highest returns there. We're up 51% in Diamondback Energy, ticker FANG, and closed our position in Devon Energy, ticker DVN, for a 54% gain. Oil stocks got crushed earlier this year when the price of crude went negative for the first time ever, and these companies went into survival mode. Stocks in the sector are the worst performing this year. This chart by the Sector Spider Funds shows the year-to-date returns for each of the 11 sectors and the S&P 500 index, with energy one of the only 4 sectors to report a loss. But that blood in the streets kind of sell-off could mean these stocks have even further to rebound, even after the sector has already jumped 37% in the last month alone, more than 7 times the market return. Companies in the energy sector beat earnings estimates by an average 66% in the third quarter. The chart here shows how much companies in each sector beat on average those analyst earnings expectations for that quarter. That beat by energy stocks more than 3 times the average 20% earnings beat for companies in that S&P 500 index. And that run might not be over. The price of crude has jumped in the last month and is up over 13% since the end of the third quarter. Since these stocks have already run that 37% in the past month though, there's a good chance we could see outperformance for at least another year. So what I want to do with this video is show you the analyst research behind oil stocks. How high could these stocks go? Then I'll explain why you don't need to be worried about that electric vehicle sales destroying oil demand, and then reveal those 5 oil stocks to buy for the next year. In fact, I bought one of these for our 2021 Bowtie Nation portfolio on StockCard. Just 2 months into the portfolio, and we're up 30%, beating the market by 25% over the period. I'll leave a link in the video description below. It's free to follow the portfolio, and you'll get notifications whenever I buy or sell from the list, even before these videos come out. As a special bonus though, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code BOWTIENATION, all one word in lowercase, for an exclusive discount beyond the free trial. Now with that rebound in the price of crude, analysts expect the energy sector to post the highest returns in the market over the next 12 months, pretty much dwarfing everything else you see here. So what we're looking at here is the sector level expected returns. The analysts polled by FactSet Research, they took the difference in the average target price for all the stocks in that sector and then the current closing price on those stocks for a return estimate for each sector. And you see, analysts expect stocks in the energy sector to post a 46% return from November. So even after the run last month, that's still another 15% or more on the upside. That would still put it on par with expectations here for healthcare stocks and those in the financials, the next 2 stocks higher here. And why I think these could go even higher, it's really all about oil supply and the overreaction to this year's plunge in prices. This chart from the U.S. Energy Information Administration shows world production of fuels in the brown line and then consumption in blue. And you see that drop in demand from about 100 million barrels a day down to about 90 million. But look at the reaction in supply. Oil production dropped from just keeping up with demand to 85 million barrels a day, a deficit of 5 million barrels a day, even during the worst of the lockdowns. And while this graph shows production rebounding pretty quickly, I think it's overestimating the speed at which drillers can come back online. The EIA estimates total global production to rebound to just 97.4 million barrels of oil a day next year. That's just under the estimate for 98.2 million barrels a day in consumption. Now the problem is though here, drillers and everyone in the space has really severely cut their investment spending for the year. For example, Chevron announced last week it was going to cut capital spending by 26% over the next year, shaving $5 billion off what it's spending to find and develop those oil fields. So first, that's going to result in just lower production than expected, and I don't think the market is ready for this. These kinds of investment cuts are happening with every oil company, just slashing the amount they spend to find and produce that crude. And second, if we get any kind of an economic recovery, and right now the market is pricing in growth of at least 4%, and especially if airline travel rebounds, that could drive oil demand well over that 101 million barrels a day used in 2019. So if we just do some quick back of the envelope math here, if oil supply comes in at maybe 96 million barrels a day, and demand surprises to the upside to maybe 101 million barrels, that's a deficit of 5 million barrels of oil every day on the market. A deficit that could take the price of crude back up to $50 and $60 a barrel real fast. Now, okay, I know what you're all saying out there, but Elon Musk is going to kill fossil fuels. Everyone is going to be driving electric cars soon, and big oil is dead, right? Hold up there, sport. Maybe a little perspective is going to help bring some reality back into this discussion. Global electric vehicle sales were 2.1 million last year for about 2.6% of the total vehicle market. Now, market researcher Frost & Sullivan expects the market to grow to 6.9 million sales by 2025, which granted, that would be a very strong 27% annualized pace, but would still only be 8.6% of the total car market. So think about it this way. Online sales as a percentage of total retail sales hit 2.1%, so the same market share we're talking about with electric vehicles here, in 2004. And just further perspective there, the market share for online sales hit 8.6% in 2016, 12 years later. Now, was the shift to online sales a worry for retailers back in 2004? Yeah, kind of, but nobody was talking about the death of brick and mortar stores. Even when that share of online sales hit that 9 and 10%, traditional retailers were still just starting to feel the pinch. My point is, yes, the rise of electric vehicles is an annoyance to oil companies right now, but at 2.6% of the market, it's more of like a fly at this point. Even on that 27% annual increase in EV sales, it's not going to save us if we have a 5 million barrels a day oil deficit. Oil prices will go up, and so will the shares of these oil companies. So maybe these 5 oil stocks aren't something you're going to hold on to for 20 or 30 years or more, because maybe someday, some faraway time when cars run on dreams and everything is rainbows and unicorns, someday maybe we break our 161-year dependence on crude oil. But until then, and at least over the next 5 years, these stocks have a clear runway higher. Our first oil stock for 2021 is one I've held for quite a while actually, a $176 billion oil major, Chevron, ticker CVX, and its 5.5% dividend yield. And while Chevron does have a lot of those retail gas stations and the LNG assets, so a lot of revenues outside the production segment, it's still very much an E&P company. This is really where the company excels though, as a low-cost crude producer. Research here by Morningstar shows the 2020 and 2021 break-even prices for these major oil producers. That's the blue and the red dots here in the graph. And what you see is Chevron has one of the lowest break-even prices in the industry. The company is profitable with oil around $50 a barrel, and that gives it a lot of flexibility in field development and in spending. The company has a strong history of dividend payouts, with a 6% increase in the last year, which is pretty amazing considering how bad it's been for this industry. Earnings are expected to rebound to $2.75 a share next year from a 2020 loss, and then to $4.84 a share in 2022. The average analyst target is for $98 a share here over the next year, which is only 7% higher, but on top of that, healthy dividend yield, and this one I think keeps running for years to come. EOG Resources, ticker EOG, is in the top 5 for analyst return expectations, with a price target of $64 a share and a 2.8% dividend yield. I highlighted EOG a month ago in a video on stocks for upside on Q3 earnings surprises. The company actually did end up beating earnings expectations by 126%, with shares jumping 38% since then. The average analyst target here still leaves 23% upside to the shares, and the company is one of the best run in the industry. It's drilling over 10,000 sites with enough reserves for more than a decade of production, so it can afford to cut spending and still produce at a fairly high level. Now that's what's boosted that profitability and helped it double those earnings expectations. Kinder Morgan, ticker KMI, is a midstream company, which means it owns the pipelines and the storage facilities and pays a very strong 7.1% dividend yield. The company owns more than 80,000 miles of oil and gas pipeline across the United States and draws constant fees from those oil companies to use those assets. This is another one I've been following lately because of massive insider buying. Co-founder and chairman Rich Kinder alone has added over 1.5 million shares this year, boosting his ownership of the company to 11%, worth $3.7 billion. These are just some great cash flow assets, collecting a fee from producers just for moving that oil and gas through the pipelines. Even after slowing that dividend growth this year to protect the cash flow, the payout has still doubled since 2017. Distributable cash flow is expected at $5.1 billion this year, so plenty of cash survivability and the potential to take advantage of those lower prices in the oil and gas space. Now, besides that solid dividend, though, the average analyst target for shares here is at $17.60 each, a return of more than 19% above the current price. We're adding a renewables pick to the list here with Renewable Energy Group, ticker REGI, a leader in the biofuel space. The company operates 12 biodiesel refineries globally, producing nearly 500 million gallons and $2.6 billion in sales. Renewable energy booked a 30% annual growth in sales over the decade through 2019, and this fuel is going to be a key driver for companies needing to cut their carbon emissions over the next decade. I like using the management effectiveness stock card here to see how the company stacks up in that return on assets, the ROA, and then the return on invested capital, the ROIC. Now, this company's ROIC of 49% is 10 times the sector average, and management has been able to produce that 40% return on assets over the past year, which is pretty much unheard of in any sector. Now, this one doesn't pay a dividend yet, but I think it's on the horizon, and the average analyst target of $72.60 a share is 22% higher than the current price. In fact, I think this one pushes even higher than that price target, and I added it to our 2021 Bowtie Nation portfolio last week. I like all 5 of these stocks here on the potential upside, but this one combines the renewables energy theme and some great management, all for the win. Phillips 66, ticker PSX, is another high dividend pick and some great diversification for a large producer. Now, I like Phillips here, especially in a more diversified oil and gas portfolio, because it's got a lot more diversified revenue stream than you see with most of these large oil companies. And besides the familiar retail gas stations that it has, the company has refineries, midstream pipelines, and a chemicals business that really sets it apart. I love the diversification here, and it's got a strong balance sheet with enough cash flow to keep up those dividend increases. The average analyst target for shares is only 7% higher from here, but on top of that, 5.4% dividend yield makes a double-digit return and upside in the future. Click on the video to the right for the next FANG stocks. These 7 stocks are up 33% in 4 months, but have a lot further to go. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.